Welcome to Phillip Futures Market Watch. My name is Lee Zhen Hui, and I'm an investment analyst with Phillip Futures. With much focus on Greece in recent weeks, market attention on Portugal has been downplayed. Nonetheless, once the Greece debt deal concludes, Portugal could become the next candidate to face market scrutiny. Here are two reasons why. Firstly, Portuguese bond yield continues to increase, despite the cheap 3-year European Central Bank ECB loan. This graph shows the 10-year sovereign bond yields for Italy, Spain, Ireland, and Portugal from October 2011 till January 2012. Higher bond yield is undesirable, as it also means a higher borrowing cost. The blue vertical line indicates the point in time when major central banks made it cheaper for banks to borrow US dollars during emergencies. The red vertical line indicates the point in time when the special loan was dished out by ECB. Both measures reduced strains in financial markets and drove most Eurozone bond yields down. Italian, Spanish and Irish bonds have rallied as banks used some of the ECB loans to buy Eurozone sovereign debt. However, it is apparent that this cash has not helped Portugal. Portugal's borrowing cost for 10 years recently rose to above 15%. This prompted the ECB to buy Portuguese debt in the secondary market to keep the bond yield down. While the central bank's intervention is helpful in the short term, barring any change in the ECB's current intermittent intervention approach, investors are likely to regain confidence in Portuguese bonds. The second reason why Portugal could be next in line after Greece is the diminished liquidity of the Portuguese bond market. As the bid-ask spread of Portuguese 10-year bond increases, market liquidity drops. Without a liquid market, fewer investors are likely to buy Portuguese bonds, and this reinforces the negative feedback loop, driving Portuguese bonds even higher. In summary, higher borrowing costs and lower liquidity of Portuguese bond could be potential catalysts that forces Portugal to seek another bailout, or even a debt restructuring. With a heightened risk of another bailout, the rally in equity markets in US and Europe could jolt to a sudden halt due to increase in risk aversion. Therefore, it is timely for us to relook at the composition of our investment portfolio. Those significantly exposed to equities could perhaps consider hedging by trading in stock index futures. For more information on the risk and return of investing in stock index futures, feel free to approach any representatives from Phillip Futures for further discussion. Thank you and stay tuned for more Market Watch videos.